Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us again here at Ausbiz. Let's get across those market moves overnight and global equities and bonds surging on speculation of a potential de-escalation of the war in the Middle East, with Europe's benchmark stock 600 index rebounding, having fallen 8% in March. Stocks on Wall Street soared on reports that President Trump was willing to end the military campaign against Iran, even if the Strait of Hormuz remains largely closed, while media in Iran quoted the nation's president saying that it is seeking an end to the war. The month-long conflict has left the S&P 500 and Dow on track for their deepest quarterly declines since 2022. Tech stocks led the rally on Wall Street, with Nvidia, Alphabet and Tesla shares surging. Chipmaker Marvell Technology shares jumped, with Nvidia investing $2 billion in the company, and it will join Nvidia's ecosystem. CoreWeave rallied after securing an $8.5 billion loan to expand AI infrastructure. Unilever agreed to separate its food unit and merge it with McCormick in a cash and stock deal, valuing the spice maker at around $45 billion. Constellation Energy falling after forecasting 2026 profit below expectations. And space tourism company Virgin Galactic shares took off as it targets quarterly positive cash flows as early as next year, with the aim of launching at least 10 flights per month by the second quarter of 2027. Well, US Defense Secretary Pete Hegseth says the next few days in the war against Iran would be decisive, and warned Iran that the conflict would intensify if it did not make a deal. President Trump, meanwhile, has criticised countries that have not helped the US war effort. In a social media post, he said countries will have to start learning how to fight for yourself. The USA won't be there to help you anymore, just like you weren't there for us. Iran has been essentially decimated. The hard part is done. Go get your own oil. Well, US consumer confidence unexpectedly edged higher in March, but households remain downbeat about the labour market and anticipated higher inflation over the next 12 months. And the US unemployment rate rose to 4.4% in February from 4.3% the previous month, job openings falling in February. The US Treasuries ended the first quarter high, rebounding after a month of heavy selling and rallying in line with stocks on the reports of a possible de-escalation in the Middle East conflict. The US 2-year Treasury yield falling to 3.79%, the 10-year was down to 4.31%. Australian 3-year government bond yields fell to 4.65%, the 10-year has fallen back below 5% to 4.98%. The US dollar index down around 0.5% on the day. The Aussie is back up to 69 US cents. And Brent futures for June delivery fell more than $3 on reports that Iran's president said the country was ready to end the war. The Brent June contract fell close to $104 a barrel, while Brent crude futures for May rose 5% to $118 a barrel. Gold has risen, but has recorded its steepest monthly decline since 2008 on persistent inflation concerns and expectations of higher interest rates. Spot gold up more than 3% to around $4,670 an ounce. Copper was up 2%, iron ore off slightly to $110 a tonne, and improved risk sentiment has pushed Bitcoin back up above 68,000 US dollars. Well, joining us now is Anu Ganti, head of US Index Investment Strategy at S&P Dow Jones Indices. Anu, terrific to have you back as we round out that quarter just gone. But first off, let's take a look at those moves we saw in that session just gone. How would you sum up those moves?
It was certainly a robust rally to see. The S&P 500 was up 3%. It was the best day so far in Q1 2026. So what a way to end the quarter. But having said that, Andrew, the S&P 500 still closed the quarter down 4%. It was the worst quarter since Q3 of 2022. You, of course, mentioned 2022 earlier in your remarks. So there's a lot of parallels to that time period and some differences as well. But it was certainly a tough quarter. If you break it down, there was a trifecta of concerns with tariff tensions continuing to mount, AI-related concerns, private credit worries. And then all of a sudden at the end of February, we saw the Middle East conflict escalate. So you put all of that together and now we've come back with a resurgence on the final day. Just breaking it down further, it was very interesting to look at sector performances. Energy was the only sector to post a gain in March. It, of course, outperformed in Q1 given the rising oil prices that we've seen. But very interesting to see these reversals on the final day with oil declining, with Treasury yields declining, with the rise in gold. The big question is whether this will continue.
Well, Anu, you mentioned those cross currents at play during that quarter. Let's break that down then. Beginning with prior to the conflict, of course, the focus was very much on the AI disruption, particularly in regards to software companies. What did you see there, particularly with the S&P Software and Services Index?
Yes, it's a great question. And if you look at the big tech sectors, they were all hit hard in the quarter. Think about communication services, consumer discretionary, information technology. If we look further under the hood at our select industry indices, severe pain within the software and services arena. Our index, software and services index, was down roughly 24%. Now, having said that, if you switch gears and look at our S&P Semiconductors select industry index, it was up roughly 2%. So a big performance differential right there. The question again is, as we look ahead to earnings season and beyond, is whether that divergence will continue. Of course, we've seen significant CapEx spending by these big tech companies and the hyperscalers and spending on data centers. So that is a question. And of course, we're all closely watching oil prices and the rise that we saw so far in Q1. It's very closely interlinked with these semiconductor companies who, with those big CapEx spending on the data centers and thinking about the rising component costs. So important not to think of these as separate themes, but the impact of software and semiconductors and AI will be closely intertwined with oil prices and inflation concerns, which we're watching.
That's a great point there. Anu, let's then turn to what happened in March, of course, dominated by the conflict in the Middle East as investors were pretty much influenced by those macro moves. How has that played out, particularly as far as what you're seeing with dispersion and correlations?
Yes, and that is one of my favorite topics to talk about is volatility. And I remember the last time I was on, we talked about the decline in idiosyncratic risk and dispersion, the rise in correlations. As of today, we're continuing to see those high correlations, especially on the implied side with the market's expectation of correlations in the future. And you see that chart up there. So big difference in terms of macro, the return of the macro coming back. Now, of course, with the relief rally that we saw today, with earnings season on the horizon, the question is whether a reversal could potentially happen with fundamentals coming back. So we shall see, but that'll play a potential impact on, of course, big tech companies, energy companies, international, if you think about emerging markets and the impact of rising oil prices across oil exporters versus importers, that'll be another trend to watch as well. Final point on this topic is thinking about correlations. Equity versus bond correlations have turned positive, both with short-term bonds and long-term bonds. That could be a potential headwind when thinking about asset class diversification. So that'll be something to stay tuned on.
And Anu, how's that played out for, given both dispersion there, but also what you've seen with correlations in terms of volatility, how that has played out?
Yes, we've seen that rise in volatility because if you think about the components of volatility, it's dispersion and correlation. So we've seen the rise in volatility, especially in cross-asset volatility. Oil implied volatility has risen. It's relatively high right now. If you look at our VIX high yield index, looking at credit implied volatility, that has more than tripled as well since the start of the year. So especially high if you think about it compared to equity implied volatility or the VIX. And the other point to look at is, of course, is our implied dispersion index, DSPX. It's remained relatively high. It has come down a little bit. It's come up a bit in the past couple of days. So realized and implied volatility will be something to watch as we begin the next quarter. And the final point is just looking at the spread, the implied volatility spread will be something important to pay attention to as we think about earnings season. And of course, the Fed's future rate trajectory.
And always terrific data across what you're seeing with US markets. Thanks so much for joining us from S&P Dow Jones Indices.
Thank you.
Let's now turn our attention to the local market then, ahead of our start here on this Wednesday. And we are expecting, well, as you can see, up 1.5%. So a little more muted, certainly compared with those gains that we saw on Wall Street, particularly with the NASDAQ, more than 3.5%. With those stocks soaring in response to more headlines out of the Middle East in regards to comments from President Trump saying he is seeking that off-ramp, but no solution to the closure of the Strait of Hormuz, whereas Iran media reporting that the country is also looking to end the conflict. Stay with us, the Open is just around the corner.